everyone, and welcome to the week ahead. I'm Tony Nash. Today we have Michael Belkin, Tracy Shuchart, and Albert Marco, who will come on later. We're talking through an ongoing sector rotation, which Michael's been writing about for some time and publishing in his weekly newsletter. So we're gonna talk through some of the calls he's made around tech and around energy, and then ongoing kind of what he's looking on in his portfolio. With Tracy, we're going to talk about some large oil and gas company transactions and some votes that happened with Exxon. We'll go through all of those in detail. And then with Albert, hopefully we'll talk through Fed QE Yellen's QE versus Powell's QT, and how they're kind of offsetting each other or battling against each other. So guys, thank you for taking the time. Michael, it's been a while since you've been here, a few months, I think. So thanks for coming back. I wanted to talk about, first of all, your newsletter is really great. I really enjoy it. And I want to talk about sector rotation. I know you talk about that a lot, and that's really the kind of one of the main drivers of your newsletter. But your note on rotation towards defensive sectors like utilities and consumer staples, what are the main drivers behind this shift? Because we talked to you, I don't know, maybe 7, 8, 9 months ago, and you were saying get out of tech or gradually get out of tech. And then you were at that point saying energy was where to be, or one of the things to be in. And now you're talking about further sector rotation. So can you talk us through a little bit of that evolution of where we've been, so that you can kind of do a victory lap, but also where do you see us going?
Okay, yeah, thank you for the introduction. So what I do, just to review, I have a forecasting model based on time series analysis. It gives a 12-period forward forecast using weekly data, mostly, also monthly data. So 3-month forecast horizon, also 12-month. And it depends, so the model gives direction, position, intensity. I developed this out of my studies at UC Berkeley, Stat Department, Business School, and then I applied it at Solomon Brothers in proprietary trading. I was a quantitative strategist. I've been doing it ever since. 30-something years now at the Belkin report. So direction, position, intensity, forward-looking. So a lot of times what I'm saying sounds kind of contrarian. It might be the opposite of what's happening on the screen. So I'm just looking for how things will change. Mm-hmm. So like you said, energy was a big model. It was stressing long outperform energy, months ago. That's kind of worked, not massively. It worked for a while, pulled back. It's still there, but it's late. So in position, energy's kind of late, So I still have it, but it's like, well, I got one foot out the door. So I'm still halfway in energy. I still have some stocks. A lot of the individual stocks have kind of been crappy, though. The energy service stocks have been sort of kind of faltering one after another. So it's been narrowing, and energy's been it's just been narrowing. So it's late, maybe 7th, 8th inning, still there, but not super strong signal anymore. What replaced that about 3 months ago was utilities. Now, utilities are typically the most defensive sector, right? It's like something nobody wants to own, low beta, no growth, anything. So, about 2-3 months ago, it became my top, one of my top 3 sectors. I also include gold stocks in there, by the way. So I have gold, XAU. I include it as a sector, even though it's more like group than a sector, but it's just so contrarian. It's there's only 10 or 11 S&P sectors. So utilities have outperformed massively. They've been the best performing sector so far in the last 2 months. Bottomed March-ish, so March, April. So here we are, May, like end of March, about 2-3 months, utilities, and they're getting the AI story, right? So there's been a few single super hot utility stocks that hedge funds own. Those have spiked up. They're up a lot. The model generally likes to buy low and sell high. and it's looking at ratios, so it's not necessarily an absolute thing. So utilities were in the gutter. They've come back some, but it's more like second, third inning in the forecast, like utilities. Staples, no, hang on a second. Utilities, what's the rationale? AI, yeah, I mean, and EVs and everything, we're going to need a lot more electricity. So utilities can become sort of a growth thing. That's the scenario. That's the catalyst that people are talking about. But really, it's a super defensive sector. So it shows a risk-off move in the market. And along with that theme, consumer staples. So consumer staples are just maybe first inning. If you look at a ratio of XLP to SPY, it's way down. Nobody likes them. Food companies, Campbell's Soup, General Mills, things like that. Out of favor. Nobody likes them. It's the thing that that investors go to in a risk-off move. And so what I'm seeing is my scenario is the market's really super overbought. Everybody's overloaded in these super high tech stocks, which are my shorts, and they're actually working. So NVIDIA is obviously not. That's been a hard one. And the Mag 7, some of the others are working, not so great. Nothing huge there, but they're not like leading the market except for NVIDIA. It's more down from Mag 8 to like Mag 1, NVIDIA, and that probably won't last. But what has been working for me is shorting cloud software stocks. So today we have, all kinds of, there's a bunch of them that have just collapsed today. So CLOU, that's an ETF. It's not very liquid, but it's been my top short. And basically, if you look at the constituents of that, it's all the stocks that hedge funds and family offices own. If you look at SEC reports, it's, I'm not picking on them, but this is what they're overloading on. So everybody's bought in, into this AI scenario where AI is going to change the world. Reminds me a lot of the tech TMT bubble top back in 2000. And of course, tech, that was a top in the market, and something was happening then. Yeah, right. Internet was a new thing and all these companies. But, at the top from March, like the NASDAQ went down, like 80, 90%. And a lot of those stocks just disappeared. And of course, years later, we have the winners in the internet, Amazon and Meta and all these things. But so now I think we're at a similar point in AI where, yeah, it's going to be something big, but we don't know yet. So a lot of these stocks that people are buying are really speculative, and there's going to be a huge shakeout. So those are shorts, for me, and they're working, not massively, but certainly today they're working. This week they're working. So and so we have this rotation. People are overloaded in tech, completely out of defensives. And what will drive this? To me, it's a recession. Okay, so we're maybe this is not the right segment to talk about that, but basically the economy slows down. The companies warn, like we're getting today with Salesforce, down 15% or something, and they're saying, or just disappointing Wall Street, and then people dump the stocks. Goldman Sachs downgrades them. So that's the kind of paradigm we're in.
Let's talk about recession in just a little bit. You were on tech, Michael, and I want to. You talked about that quite a lot, but I want to talk a little bit about geopolitical risks and NVIDIA. You mentioned that in your newsletter. Can you talk us through that from your perspective?
Sure. So everybody loves NVIDIA, right, on Wall Street. It's it's the analyst's favorite stock. It makes perfect sense if you look. You look at their earnings, you look at earnings growth, et cetera. It's overvalued and everybody owns it. So that's the downside. But just think about this for a second. All their processors are made by Taiwan Semiconductor in Taiwan, right? And what's happening in Taiwan? Hello, China is sitting there running these war games, every other week. And I'm not going to predict, that China is going to invade Taiwan tonight or this weekend or something. I don't know. Who knows? But it's certainly a threat there, and I do not think it's reflected the risk of NVIDIA's backlog and orders and everything just going up in smoke. If China blockades Taiwan, which they were just threatening in these war games, they surrounded it with ships, and if they could just cut off the internet connection and everything, and it would be a mess, So I just don't think the risk I'm not saying it's going to happen again. This is not my prediction, but it's certainly a geopolitical risk that's not reflected in the price of the stock. Their orders could just disappear, vanish.
What's a little bit strange to me is, post 2008, investment banks got rid of a lot of their geopolitical risk analysts. So we had ZERP and NERP, and geopolitical risk was effectively zero rated. Nobody really factored geopolitical risk into their valuations. Now that we have interest rates at 5+, you would think that geopolitical risk would be a factor, but it's really not. We had all of this stuff in the Middle East with Iran and, with Israel and with Palestine. And, we have the China, Taiwan deal. And I don't know, and I'd be curious what you think on this. Have people forgotten how to factor geopolitical risk into their valuations? Or is it really, do they really believe it's not a factor?
Good question. So it's a global, here's a roundabout answer to your question. I also cover all these global macro things, and a lot of these emerging markets that are right next to Ukraine, Bulgaria, they're up in the stratosphere. So there's been this crazy buying. I don't know who's doing this, if the NATO is buying these markets, so it's good to try to restore, keep confidence up. But there's been this huge rush into very risky places that are right next to war zones, like, Taiwan for one, Estonia, Bulgaria, Romania. These might not be important markets to anyone, but they're measures of this crazy risk on sentiment where people completely disregard geopolitical risk and they almost flood into it. They embrace it as if it doesn't exist. Meanwhile, the Houthis are shooting. They hit a bulk carrier with three missiles, a couple of days ago.
Yep.
It's limping back to port. So there's all this kind of stuff in the world, and there's a very weird mismatch between what people's willingness, investors' willingness to embrace risk and really disregard the potential bad things that could happen. Everywhere I see this.
Even a basic understanding of risk calibration, right? So it seems like risk discussions are either 0 or 11. There's really no in between. Either everyone's screaming that China's going to invade Taiwan overnight, or it's going to be, regional war in the Middle East or something like that, or it's just dismissed, not a big deal, right? There's no kind of 5 or 6 level risk, where you're kind of hedging, you're kind of making sure that things are going to be okay. There's a little bit more sophisticated analysis, that sort of thing. So for geopolitical risk, it's so strange to watch these guys. And I used to be in that business when I was with The Economist and with IHS. Today, geopolitical risk is either 0 or it's 11. There's nothing in between. It's panic or it's complete dismissal. And it's a really weird lack of discipline there and lack of awareness.
Yes, absolutely. And what it sets up the potential for is when you're when you completely ignore it and something comes out, it seems seemingly out of left field, but it's been there all along, where a missile from, Russia goes across the border, into Romania or something. And then there's a response, or the same thing in Taiwan, right. Something just happens. I mean, the risk of something like that happening when people are not set up for it, it can really sort of, light a match, and cause sort of panic, people to sell, just push the sell button, right, and dump everything, in that. So I think there's a danger of that. Everywhere I look in the world right now, people are ignoring risk. They're in all these crazy things that are risky, that are toppy, and they're overowned. So there's really heavy investment ownership in risky assets without regard for the downside risk.
Tracy, do you see that in energy and commodity markets? Do you believe there's I guess a sophisticated approach to understanding geopolitical risk in energy and commodity markets, or do you believe it's something that is just an atrophied muscle kind of?
I think that, obviously we saw that happen after the Russian invasion of Ukraine, right? We saw energy prices soar. I think after that, it's kind of laissez-faire attitude there, so to speak. There's a lot of geopolitical risk. I mean, oil prices are still elevated. We're talking, $78, $79 in WTI and $80, $81 in, Brent. So it's not like, oil prices have completely collapsed or anything of that nature. So it's still keeping prices elevated, but I think everybody expected, oil prices to spike kind of like they did in February of, 2022 after the invasion of Ukraine, except for, I think that, I think it's just kind of a laissez-faire attitude. Everybody's happy with oil prices as it is. Yes, there's problems in the Red Sea, but, we're not, mostly everybody's avoiding that area, so it's not really a problem anymore. I think there's a lot more risk to the shipping industry, particularly with oil vessels, but that's a whole nother subject that we can talk about later. But again, yeah, I think there's kind of a laissez-faire attitude as far as what's going on, particularly when we look at Taiwan. They're a huge importer of LNG. They don't have a lot of storage. So if they had like a maritime blockade, doesn't even have to be an invasion, just a maritime blockade from China for any reason, they've got 10 to 11 days, and they're a huge chip maker. And so these are kind of the risks that I think people are maybe not understanding right now.
Yeah, and I think it's really hard for people who aren't, experts and, historians to understand a blockade is so much easier than an invasion.
Right.
The blockade is what the US did to Cuba in the 60s, and it was very successful. An invasion is what the US did into Iwo Jima and the other Pacific Islands, and you had huge casualties on both sides. So China practicing a blockade, that's a pretty straightforward way to get what they want. Like you say, Michael, is China going to invade tonight, or are they going to invade in 2029? Well, maybe they're not going to invade. Maybe they're just going to have a blockade, right? And so that's a different level of risk, a different magnitude of, say, damage and rebuilding that's required, that sort of thing, right? So, and these things are not really discussed all that much, I think. So that's a really good point, Tracy. But one of the things with risk that I feel isn't really fully, say, priced in or appreciated yet is the fact that we do have higher interest rates. A number of these equities are trading like we still have zero rate in interest rates. So, Michael, can you talk a little bit about the yield curve inversion? You mentioned that in your newsletter as well. So can you talk through that a little bit?
Okay, yeah, so the economic picture goes like this. So you have to take a few steps back to understand how we got here. So we had COVID hit. They threw stimulus at the economy, crazy fiscal and monetary stimulus, unprecedented amount, 5-6%, just an enormous amount of stimulus. And then they said, it's not going to create inflation. Inflation is transitory, blah, blah, blah. Then inflation zoomed to 9%. Then the Fed started tightening 2 years ago. So March 2022. So it's been 26 months, right? And then the yield curve inverted about 3 or 4 months after that. So basically, we had declining inflation until about 3, 4, or 5 months ago. Inflation's kind of bottomed out, right? And I was bearish on inflation back, 18 months ago. Now it looks to me like it's not huge surge, but I think it's headed back up. So for instance, the CPI core 3-month annualized rate is 4%, twice the Fed's target, right? And people are saying, oh, Fed's going to cut, you know. And it's funny, you know, these Fed people, man, like just think about it, like 6 months ago, everywhere you look, they're all over the place. Yeah,
How many was it? Cuts, 9 cuts in 24 is what they were saying, something?
Yeah, I mean, they were, every Fed speakers were all over. They have this, they feel like they're obliged to go and tell people what they're going to do. And they're completely wrong. Like, so it didn't happen. And it's pretty funny. Like there's a reaction function where the Fed is promising interest rates cuts, which actually made financial conditions loosen, right? So they're trying, on the one hand, they have high interest rates and they're doing QT, which ought to be tightening financial conditions. But we have these ultra low financial conditions, which are created this AI bubble. And it's, you know, it's part of all that. So anyways, I was short bonds until a couple of weeks ago in the model forecast. I covered the short. I am now long bonds. Now, this is very contrary. So the yield curve, we're 19 months, 20 months next week into an inversion. And that's the amount of time, general amount of time that preceded recessions in 73, 80, and 2007. Now, it's not brain, you know, this isn't brain surgery or, you know, it's not absolutely precision, but it just shows that the Fed's keeping interest rates high. And for some reason, longer term interest rates are below Fed interest rates. So I actually think that's going to get worse because I don't think the Fed's going to cut anytime soon because of inflation. And I think bonds are going to rally. So brand new signal hasn't worked this week. It's working today. But why would bonds rally? Because the economy is slowing down. The recession signal is here. Industrial production has been going nowhere, sliding down. Capacity utilization, all this typical stuff of business cycle indicators. And all of a sudden, we're getting companies warning of falling sales and disappointing revenues and stuff. That's the way a recession seeps in. So it's not hitting like a jolt, you know, a lightning bolt. It's kind of a slow creep. So I think bonds could rally as a generalized risk-off move out of risky assets into safe assets. And that means treasury bonds, not junk bonds, not credit spreads, things like that. So
talking longer duration, 20
yeah,
years.
So 10, 30 year kind of things like that. So I think those are a buy. That's what I'm telling my clients to buy bonds, which is totally contrarian. If you look at like the CTAs are massively short bonds, you know, so that could actually be a positive for a bond rally. CTAs cover. Why would bonds rally with inflation high? Doesn't make intuitive sense, except in a risk-off move, recession happens, asset allocators. By the way, going back to my days at Solomon Brothers, I saw this happen in the 87 crash. Stocks crashed and all of a sudden bonds went up like 20 points, you know. So bonds have been selling off and then it finally broke the back of the stock market. I had been there at Solomon for a year. I was in market analysis with Laszlo Barini at the time. And I saw this happen. I saw asset allocators. It was General Motors pension fund, you know, doing the trade through us at the time, dumped all their stocks and switched into bonds. So there's this potential for big asset allocators to push the button and say, get me out. This cycle's over. I've made a lot of money in stocks. I want to preserve that and you know, put it into the so-called safe asset.
Yeah, it almost feels like that's ready to happen, but we're not, it doesn't feel like we're quite there yet, right? I mean, as data people, not necessarily kind of technical right now data people, but saying longer term like you and me, you know, we always feel like we see it long time before it happens. And we're just waiting and waiting and waiting. It's like, it's going to happen, you know, but, you know, over the years, I've taught myself that I'm probably 9 to 12 months before things actually start to go the direction I think they're going to go. Because you just see the data and you're sensitive to the data, right?
Right. Yeah. Well, that's the old saying on Wall Street, being right too early, you know, this is a euphemism for being wrong. However, so this is what I do though. I try to catch these inflection points in things. And usually, not always, it's very controversial and very, you know, it's going against how people are positioned. And it sounds ridiculous. But most of the time, the model comes through on these, particularly when I'm seeing it in the sector rotation, you know, into defensives, things that resemble bonds, consumer staples. These are high yielding defensive things, utilities. By the way, same thing in Europe. This is a global thing. So utilities, food and beverages, healthcare in Europe, and tech and all the industrials, autos and parts. So the flip side of this, which I didn't mention, is cyclicals are selling off like crazy. So I have an early downward forecast for industrials, all these construction companies that they've had a huge rally. So it's out of cyclicals, which investors are overweight, and into defensives. So I try to pick these points. It's not, I'm not 100% successful at it, but it always sounds contrarian, or most of the time. And I just think this is one. So I'm standing on the railroad tracks. Here's me, the train's coming. Time to get out of stocks, shift into bonds, get out of cyclical stuff, tech, into defensive groups if you're long only.
Joe Michael, we're used to that. In the year or so you've been on the show, and I know you've been doing this for decades, but to see you highlight this stuff and say you're the guy on the tracks holding things back, and then 2 months later we see it happen, it's fantastic. So that's really great. So thank you for this. And then I think there was one last thing. Oh, you talked about a selective recession. Can you talk us through what you mean by selective recession?
All right. So on the one hand, again, you've got NVIDIA, you've got these handful of companies that look great to stock analysts because they have earnings growth, et cetera. And it makes perfect sense. So if you're working for a hedge fund, one of these big bulge bracket hedge funds, are you going to say short NVIDIA? I don't think so. I mean, everybody's long it. It just makes sense. But then you've got, like, look today, Kohl's, Kohls, big major retailer, multi-line retailer. Same thing with Target. So, I mean, the consumer is hurting. Okay, so right now we have consumer sentiment, and it's mostly lower income, moderate income people. So what's happened is, inflation isn't 9% anymore, but that's a rate of change. What's happened is the absolute price level has gone up. So people are paying more for insurance and health insurance and car insurance, house insurance. And basically there was this survey that LendingTree just did where some 80% or something of people view fast food as a luxury now because the price has gone up so much. So it's hitting at the lower end of consumers. Meanwhile, investors and higher income people are still feeling, everything's so good. The market's up. I'm feeling wealthy. Okay, so what's going to change that? The stock market goes down. People get bombed. All of a sudden, their wealth, their 401k, which looked like was going to be a 601k, is now a 201k, and they go, oh, shoot.
Right. Exactly.
So I think that's looking forward. Change in sentiment. Right now, it's mostly on the lower incomes. But people are feeling their incomes are getting squeezed. They're having a hard time paying for stuff. I think the market goes down. That same kind of mentality will begin to infiltrate into higher income people. It's basically, oh, by the way, so luxury stocks in Europe all of a sudden sold off last month or so. So that's LVMH, Chanel, that's a subsidiary. All these, there's a handful of these luxury stocks. It has to do partly with China. They sell to China, but all of a sudden those were bulletproof. Those stocks were way up, and they were big on favorites. And all of a sudden they're selling off. So that's an early warning sign of what I'm talking about.
Okay, and it's interesting. Tracy just sent me something saying that Biden is calling on Congress to give middle-class first-time homebuyers a $10,000 credit to help with their monthly bills. So do you think this type of stuff, we'll see more of this type of stuff before the election, so people feel more of a wealth effect in the kind of lower middle income groups? Or do you think that will really help?
Could. I don't know. Biden, he seems like he has the poison chalice. It's like everything he's trying to do is not working. I don't want to get into a political discussion here. That's just an observation. I know, like they just decided to drain the gasoline reserve. I didn't even know there was one of those. I know there was a SPR, Strategic Petroleum Reserve, but apparently, so there's this. So they're pulling all the strings they can to get reelected. But it's not really working. Like if you look at his favorability ratings, and it's just they're and I don't imagine it's him You know, I mean, my wife and I were watching the show Designated Survivor, which shows an inside view about what it's like in the White House. And it's like the president is there. You've got to make all these snap decisions. These teams come to you with here's this and this. You got to make a snap decision. And we're looking, and my wife says, "Is that Biden? Like, could Biden make decisions like that?" It's like you have to make you have to know everything about every issue, and then make the decisions for who you're going to appoint to this job. And so my point in saying this is, I think there are operatives, other people are making these decisions, somebody who knows.
It's entirely possible, yeah. And so,
Yeah.
and we've said this many times before, we've got two 80-year-olds running for president in the US, and it's, I'm in my early 50s, and I can't think at the same rate that I could in my 30s, right? So I can't imagine what I'm going to be like in 30 years, so it's a difficult decision, and it's a difficult position that both guys will be put in, because your abilities slow down. That's just a part of it, unfortunately. So, okay, well, very good. Michael, thank you very much. Tracy, let's move on to some of the oil stock or oil company activity that took place over the last over the last week or so, I guess. Hess and Chevron announced a merger back in October, and Hess announced this week that they have the votes to proceed with it. You've tweeted about this, but can you give us a quick overview? Why is this happening?
Well, there's a lot of, and I said this before, there's going to be a lot of mergers and acquisitions in this field. Why? Is because companies are they're buying production. They don't actually want to invest in production. So we're coming across a lot of mergers. That said, what is starting to happen right now is some flags on antitrust issues are starting to be heralded. So I think that, we're going to see some lawsuits against this. I would assume, just because of these deals are really consolidating the industry. But so, let's go back to the HES deal with CVX. Now, the shareholders just said, okay, we'll go ahead with that. CVX shareholders didn't have to vote on that. However, this is going to be a problem. This is not 100% deal so far. So I think this is kind of to be continued. I want to say, I think the most important part about this, again, is the fact that, we're having these huge mergers right now.
Okay, so they're buying upstream capacity. Is that what they're buying mostly?
Correct.
Okay. Okay, so and that's partly because exploration in the US there's much more regulatory focus on it.
Absolutely.
And the major funds like BlackRock and CalPERS and all this stuff are trying to get them to slow down.
Well, yeah, that's a whole separate issue with
Yeah, we'll talk about that in a minute. But,
that's an entirely separate issue.
Okay. Okay, so good. So that makes sense. It's a lot of upstream production. Okay, so then if we look at ConocoPhillips and Marathon Oil, that was announced this week. Again, why are these guys merging?
Well, it makes a whole lot of sense because they have a lot of overlap in North Dakota and the Belkin.
Okay.
That makes sense. And, MRO has a lot of assets in the Permian, which is the biggest growth shale play right now. So it makes a whole lot of ConocoPhillips to kind of want to take them over. MRO is much smaller than Conoco, but, they get assets that will align with what they're already doing in other shale basins, along with get that growth in the Permian, again, not having to produce more, just buying production.
Right. Okay. And is there any midstream, refining or downstream stuff that are those huge considerations in mergers like this?
Well, I think what would be really interesting is if we see this COP merger with MRO, would be interesting to see if their refining arms consolidate, and that would be PSX and MPC. But we'll have to see what that comes along. That's a whole kind of different separate issue because MPC has a lot of assets in California, and those aren't as desirable as other places.
Right.
But they do have renewable diesel, which is desirable. VLO's made a lot of money on renewable diesel as well, and so that could look interesting to PSX. So we'll find out.
Okay, very interesting. Finally, we've had this conflict between ExxonMobil and CalPERS. Darren Woods ended up winning that battle yesterday with a shareholder vote. But can you tell us what was that battle about between CalPERS and ExxonMobil? And, you know, why did the shareholders vote with Exxon?
Well, you know, actually, I had a long conversation with Matt Cole yesterday, and Michael was there as well on my spaces. And really how Matt kind of described this was that it was more of a political move. Now, they do own $1 billion worth of XOM, but that
They,
gives
meaning CalPERS.
CalPERS, correct.
Yep.
And so they get voting rights with that. Now, $1 billion sounds like a lot, but they've got 10 billion in, you know, alternative assets. So if they can kind of get Exxon to turn their way, they're going to make a whole lot more money on that than they are going to be on Exxon. And so it was very much a political move. And, you know, we've seen this vote come to head for the last 3 years for Exxon from shareholders, and each year they've kind of voted against. This was the first year we've seen CalPERS really butt heads with Exxon, but you know, shareholders have over the last 3 years when this came up with against kind of the oil versus ESG within the company, within the board, you know, shareholders have overwhelmingly voted in favor of oil. Right. And so, you know, that says a whole lot. And, you know, as a company, you're beholden to your shareholders and you have to give them what they want. And we've seen, you know, we've seen the likes of Shell and BP recently just turn around because they try to get off track of their core business. Shareholders didn't like that very much.
Right. Yeah. I mean, you're either in the business of energy or you're not, and you have to look at a viable mix, and some of these things just aren't viable mixes, right? With
Right.
higher interest rates, which we've spoken about a few times on the show.
Million times on ESG. You know, we just saw Shell said today they're laying off a bunch of people in Europe on their, you know, wind assets because it's just not making money for them.
Right.
Shareholders don't want to see that.
So as we said before, interest rates seem to be killing ESG, right?
Well, absolutely. It's much harder to fund these projects, and these projects take a ton of money, you know, even with the subsidies. They still take a ton of money in borrowing, and, you know, it's just not feasible in a non-NERP world.
Okay. Guys, thanks very much. I really appreciate your time today, and have a great week and have a great week ahead. Thank you so much.
Thank you.